to make sure that tech is working great. I'll say this again, but if you all see my head moving around a lot, I've got several screens and we're just making sure we're firing. That tech is working great. Oops, that's my echo. Making sure everything is working well. Make sure that tech is working great. Oh, goodness gracious. There we go.
That's working great.
Yeah, it's working great. If you all see my head moving around a lot, I've got several screens and we're just making sure comical. We're firing. That tech is working. Okay, we're going to mute that. Sorry, give me 2 seconds, y'all. Let me just make sure the tech is working too well. I think that might be part of it. Oh, goodness. Let us know, y'all. Where are you joining us from? Let us know in the chat. I know people are traveling. People are doing all sorts of fun things. So we'd love to see what city you're joining us from. I'm out here in Los Angeles. I think most of you know that. From. Oh, did we lose Ari?
Still here.
All right. Oh, there you are. Okay, great. Good, good, good. Okay. Oh, did you lose Ari? We're still echoing. Give me just a second. Okay, I think I figured out where the echoing was coming from. Excellent. Well, good. Well, I see people already on YouTube. I see folks already on LinkedIn. If y'all are on and seeing us, we'd love to know that you're able to hear us and see us. Let us know in the chat where you're joining from. All right. We'll get started here in just 2 minutes. Ari, what's the weather like where you are? Is it humid?
Yeah, Cleveland, Ohio is sunny. It's nice, about 80 degrees, low humidity. Couldn't be nicer. Cleveland is the place to be in the summer. Don't come in the winter, but in the summer, absolutely stunning.
Wow, I have to admit, I did not know that. That's really good to know.
Winters get a little rough here, so.
Yeah, I would imagine. I would imagine.
Yeah, summer's absolutely stunning here.
Wow. Okay. I think I may have told you, I lived in Cincinnati for a summer when working with Procter & Gamble. It was pretty mild. I was surprised.
Yeah.
I thought the humidity was really going to be oppressive, but it was nice.
Not really, for the most part, we'll have a humid day here and there, but for the most part, pretty dry, pretty nice, not crazy hot, not cold, just very pleasant.
Terrific, terrific. Marina in Westlake Village, our neighbor to the north. Westlake Village is beautiful, Marina. Oh, and then we got Anna. She's near the Rose Bowl in La Cañada. My friend just down the street. So good to see you, Anna. Thanks for joining. Yeah, I'm out here in Pasadena. A lot of people, if you're a college football fan, you know that I'm close to the Rose Bowl. If you're not a college football fan, maybe you know the Rose Parade. We're out there. But it's it's going to be a toasty 90 degrees here. So we got the air conditioner running and all the things. Henry Lewis, Marguerite, where are you all joining from? Hey, Todd Spooner. Hey, friend. There he is. Todd, you got to meet Anna, another fellow Trojan. She just celebrated her 50-year anniversary at SC. She was at homecoming and did all the things. Yeah, Anna and Todd, you all need to meet each other. Anna, Todd lives in Texas, but we still like him. He's still Trojan. Oh, Seattle. Oh, Marguerite, Seattle must be gorgeous right now. Well, y'all, we're going to wait to 2 minutes after. So we got just 2 minutes just to let folks come in. We've got a note taker. We are live. If you're on YouTube, if you're on LinkedIn, let us know where you're joining us from. We have a really special guest here, so we're excited to get going. Some great news happened over the holiday weekend. We're really fortunate that Ari is willing to let us know all the latest updates, right?
We're still parsing through it. It's several hundred pages long, but written in legalese, so it's hard to digest all of it. But we got a decent bite out of it so far.
Good. Yes, I sent an email to Ari probably on Friday or Thursday. So if you want to know how responsive Madison Specs and Ari are, hey, let's do a webinar. Let's update everybody. All right. Well, we're 1 minute after. Kelly, good to see you. Eduardo. Hey, friend. David, Bob. Oh, this is great. Great group. Ryan, Tim, Sean. Excellent. All right. Well, I know we have a ton of people who also registered. Some mentioned that they were on vacation, so they asked me to record. So we're going to hit the record button and we're going to get going.
Okay.
All right, everyone, welcome, welcome, welcome. We are so thrilled to have you today. For those of you that are in the Zoom room, in LinkedIn, watching us from Facebook, from YouTube, we're streaming on all the services because that's how important this update is. My name is Amy Silvis. For those of you who don't know me, I am the founder and CEO of Silvis Capital. And we buy large apartment complexes in the best markets throughout the United States, like Texas and Oklahoma, Indiana. And we invite folks to invest in a hands-off way alongside of us. So if you don't like dealing with tenants, termites, and toilets, and we don't blame you, leave that to us. And you can just sit back, relax, and collect paychecks, those distributions. So I have an honored guest. It's actually his second time joining a Silvis Capital webinar, Mr. Ari Lasky. He joined us, gosh, I think it was maybe 6 or 9 months ago to talk about the tax benefits of real estate investing. And as some of you may have heard, this thing called the Big Beautiful Bill was signed on July 4th, just less than a week ago. And he is kind enough in such a short notice period of time to join us and give us some updates on what those tax benefits in real estate involve. But first, I really want to be transparent. Ari works for a company called Madison Specs, and they do what's called a cost segregation study for all of our properties. We've worked with their company for years and years and years. We're so grateful for how they help us and our investors identify these great tax benefits. So Ari is a CPA, he's an expert, and is generously giving us his time to bring us up to date on this new bill and what it can mean for us. So Ari, thank you so much for joining us today.
Oh, my pleasure, Amy. We did this about a year ago or so, and it was a lot of fun. The guys had amazing questions, some really, really good questions, kept me on my toes. So, you reached out, said, would you like to do it again? Absolutely. So, yeah, as you mentioned, this big, beautiful bill passed. We're still trying to figure out all the nuances and details, waiting for some clarification and guidance from the government. But we have a pretty decent idea of what the benefits will be, and it's pretty substantial, especially on the real estate side. So happy and excited to get into it.
I love it. Yeah, let's get into it. And folks, if you've got questions, there's a Q&A box. So make sure to put them there. Ari's kind enough to take those off-the-cuff questions that we'll address at the end. So yeah, yeah. If there's anything you can't address, that's okay too. But
yeah,
hey, you were batting 1,000 last time, so we've got faith. Yeah.
All right. So I'm gonna hide my face just so I don't distract anybody.
Same.
And let's see. All right. You still hear me all right?
Yes.
Okay. So let me just share my screen. We're gonna go through a little bit of a cost segregation 101 just to get you an idea of cost seg, how it works, how it's going to benefit you, and then we'll jump in to the one big beautiful bill, what the changes are, what the updates are, and how it's going to address you. So just confirming one more time, you see my screen?
Looks perfect. Very nice.
Beautiful. Okay. So my name is Ari Lasky. I am a CPA, been working for, I don't know how many years already in accounting, a decade or so, probably about a little over a decade and a half or so in accounting and public accounting and real estate specifically. That has been always where I've ended up, just in real estate accounting. And I've been working for Madison Specs for the last 8+ years, specializing in cost segregation. Now, Madison Specs is part of a much larger commercial real estate group. They're called Madison Commercial Real Estate Services, Madison Crest, and they offer a suite of services in the real estate world. Cost segregation studies, that's what I focus on, but we also offer other real estate services such as title, 1031 exchange, lease abstraction, due diligence reports, anything to do with real estate. We are a universally, or at least nationally, recognized leader in the real estate world when it comes to these services. So cost segregation, again, that's my expertise, my specialties, but we also offer a whole suite of other real estate services. Okay, enough about me, enough about my company. Let's get into the taxes. That's what we're here for. So just a little bit of background information. I'm sure you're all familiar with this, but we need to kind of build up to it. So some depreciation fundamentals. When you buy a piece of real estate, let's just say for $1 million, the IRS does not allow you to expense that $1 million right away. You can't just go on your tax return and say, hey, I spent $1 million on buying a piece of property, therefore I have $1 million expense. The IRS says, no, this property is going to last you many, many years. So therefore you have to do what's called capitalize. You have to capitalize this $1 million expense, and you get to expense it over a number of years. That expensing over a number of years is called depreciation. Now, depending on the type of property, commercial property, then you would depreciate it over 30, then you depreciate it over 27 and a half years. So again, this $1 million, you're going to take that $1 million, divide it over 39 years, and you would get 1/39th of that $1 million over a 39-year period. And that's how much depreciation expense you get to use to put as an expense line item on your tax return to offset the income that this property produces. Now, what my company does is called cost segregation. What cost segregation is, in a nutshell, is a IRS-approved methodology utilizing an engineer-based study that reclassifies certain assets to shorter depreciable lives, resulting in higher depreciation tax deduction in the earlier years of property ownership. In English, what does it mean? It means that we have a team of engineers. Our engineer goes down to that property and says that you did not just buy a building for $1 million, you bought a building with stuff in it. There's carpets, there's cabinetry, there's decorative lighting, there's countertops, there's appliances, there's all this stuff inside the building that, per the IRS, instead of depreciating it over a 39-year, it could be depreciated over a 5-year period. In addition, there's also land improvements. You have parking lots, paving, fences, landscaping, all the assets on the exterior, the land improvements that, per the IRS, can be depreciated over a 15-year period. So instead of depreciating the full $1 million or whatever the purchase price is over 39 years, some of that can be depreciated over a 5-year period. Some of that could be depreciated over a 15-year period. This accelerates the depreciation and creates additional taxable write-offs in the earlier years of the investment. Now, it's just some fundamentals of cost segregation. Who does it? How do you do it? So the idea is you have to have a qualified engineer. So we have a team of in-house engineers. The engineers go down to the property, they do a tour of the property, they break out all the different components. They're experts, they're specially trained in cost segregation in identifying and valuing all the various assets within the property. And then we have a team of staff and CPAs, myself included, that make sure all of the assets and the reports comply with current tax law, which, as you're aware, is constantly changing. Just to give you an idea, here are just some court cases that we have to make sure our reports are in compliance with. If you're ever having trouble sleeping at night, feel free to pick any of these. Pico Foods is one of my favorite. Absolutely take that, read at night, you will fall asleep guaranteed. Okay, since I'm more of a visual type of learner, so we spoke about our engineers going down and identifying the various assets and putting them into different groups: 5-year assets, 15-year assets, 39-year assets. Let's talk some dollar and cents. What does that actually mean? So here's just a case study. We have a client bought a property for $5 million. Without a cost segregation study, their accountant did what a typical accountant would do and depreciated the $5 million over a 39-year life. That roughly equals $128,000 every single year for the next 39 years. So they get $128,000 of depreciation expense that they could use to offset their income. What we do is we have our engineer go down there and say that the building itself is really only worth $4 million. The remaining $1 million is the 5-year personal property. Again, the countertops, the cabinetry, the decorative lighting, all the personal property within the building that can be depreciated over a 5-year period. So instead of taking the full $5 million over a 39-year period, we'll take $4 million over 39, which will equal 102. And the $1 million divided over a 5-year period is roughly $200,000 per year. I say roughly because it's not exactly divided evenly over 5 years, but for simplicity purposes, we'll just say $200,000 a year. So with the cost segregation study, we're now looking at a little over $300,000 of depreciation in the first year as opposed to $128,000. So this depreciation difference, so that's going to be extra expense that you could use to offset additional income. And again, we'll talk a little bit more later about exactly what type of income can you offset, what cannot. We'll get into that a little bit later. So when can I do a cost segregation study? The answer is really whenever you want. So it could be on a new acquisition, you buy a new property, you construct a new property, you renovate a property, or if you bought a property several years ago, or you renovated or constructed a property several years ago, we can do a cost segregation. So a new acquisition, we'll go there, see what you bought the property for, we'll categorize all the various assets into the different categories and get you that depreciation. If you built a new building, we'll look at your budgets, we'll look at the assets that were used, the different materials used in the construction, and we'll categorize those different expenses into the different groups of 5, 15, 27.5, 39-year assets to get you as much depreciation as you can. Now, what if you say, Ari, I bought this property 5 years ago, can I still do a cost segregation study? And the answer is absolutely yes. We do what's called a catch-up study or a look-back study. Essentially what we do is we look at your property and say, how much depreciation did you take? So again, back in our example, you had your $5 million purchase and your accountant has been depreciating it over a 39-year life. Now, after listening to this presentation, you say, oh my gosh, I could have been getting over $300,000 of depreciation every single year. So what we do is we go back, we see how much depreciation you have been taken over the last several years versus how much depreciation you could have taken had you done a cost segregation study back in day one. And that difference, we will catch up in the current tax year without having to do any amendment. We do what's called a 3115. It's an automatic change of accounting method. So we're notifying the IRS, hey, we've been doing this wrong. We've been depreciating everything over 39 years. We want to change that moving forward. So now instead of dividing everything over 39 years, we're going to have our 5-year assets, our 15-year assets, our 39-year assets. We're going to get more benefit. And not just that, we're going to change what we've done in the past. We're going to catch up that difference in the current tax year. So that's a 3115. We do a 481A, not to get too technical, but a 481A adjustment that calculates the missed depreciation, and we catch it up in the current tax year. Again, no amendment required. That's a very important point. Okay. So that is cost segregation. Then in 2017, the end of 2017, 2018 really, the Tax Cut and Jobs Act was passed. And this is when everybody got very excited about cost segregation. And the reason is because of bonus depreciation. Under IRC section 168K, they changed the definition of bonus depreciation. So bonus depreciation has always been around, but until 2017, it was only on brand new property, meaning new construction or newly renovated property. If you bought a building, it was not eligible for bonus. In the Tax Cut and Jobs Act, that all changed. So now even used property, as long as it was new for you, meaning the building could have been 50 years old, but this is the first time that you as a taxpayer owned this building, it was now eligible for bonus depreciation. Additionally, the bonus rate was set at 50%. Under the Tax Cut and Jobs Act, it changed it to a 100% bonus for any asset purchased and placed in service between September 28th, 2017, or as it's written here, after September 27th, 2018, and before January 1st, 2023, it was eligible for 100% bonus depreciation with phase outs starting in 2023, as we'll see in 1 second. So what assets were eligible for bonus depreciation? So the assets with a life of 20 years or less. So if you remember again, the typical building itself is going to be divided over a 39 or 27.5-year life. So those assets are not eligible for bonus depreciation. When you do a cost segregation study, we identify the 5 and 15-year assets, which have a life of less than 20 years, and therefore those assets are eligible for bonus depreciation. So that's why back in 2018 until today, that's why cost segregation has become extremely popular, is because in order to be eligible for this bonus depreciation, you first had to identify and give a value to all the assets that would be eligible for that bonus depreciation. So you do a cost segregation study, you identify the 5 and 15-year assets, and now under the new tax code, those assets are eligible for the bonus depreciation. There are certain exclusions. Assets that are being purchased and disposed of in the same year are not eligible. There is ability to opt out of bonus if you so choose. I don't know why you would want to, but you do have that option. One important note, a lot of states, most states actually, do not allow bonus depreciation on the state tax returns. So this bonus depreciation is almost exclusively for the federal taxes, not for the state taxes. Check with your accountants regarding your specific states whether or not bonus depreciation is recognized on the state tax return. Again, I like visual aids, so I'm just going to run this scenario one more time, again with the bonus depreciation. So same scenario, you have a $5 million building divided over a 39-year life. You're getting $128,000 per year for the next 39 years. If you remember the scenario we did before with the cost segregation, without the bonus, you're getting about a $300,000 depreciation in year one. Now with the bonus depreciation, so again, the $4 million is still going to be divided over a 39-year life for a $102,000 write-off in year one. Now that $1 million of 5-year assets under the Tax Cut and Jobs Act, depending on when it was placed in service, would be eligible for bonus depreciation. So assuming it fell within that 100% tax law, then we would be able to write off the full $1 million of those 5-year assets in year one, giving you a $1.1 million write-off in year one. So now you're starting to see how powerful cost segregation studies are, specifically with the bonus depreciation, whereas you were getting $128,000, now you're getting $1.1 million of depreciation.
Whoa.
Whoa is right.
Sorry, that's amazing.
Absolutely. So now just to look at the current tax law as it was before July, I should say old tax law before July 4th. So in this bottom section over here, any assets purchased and placed in service between September 28th and December 31st, 2022 would be getting 100% bonus. Anything in 2023 was getting 80% bonus. So just jump back here, this $1 million of 5-year assets, you would get 80% or 800,000 of bonus depreciation in year one. And the remaining 20% or $200,000 will be divided over a 5-year period. And then similarly for the 2024 was 60%, then 2025 it went down to 40%, and 2026 it was set to go down to 20%. Comes in the One Big Beautiful Bill. You have to love the naming. I absolutely love this. The One Big Beautiful Bill. So there's a lot in the One Big Beautiful Bill, most of which we will not be talking about today, but we're going to talk about how it relates specifically to real estate in cost segregation studies. So there's a lot of updates, very exciting things that are not necessarily taking place today regarding opportunity zones, business loss limitation carry forwards. There's a lot of interesting things, but I'm going to be talking about bonus depreciation. So 168K, that was the code section for bonus depreciation. As we just discussed, it was phasing out. 2023 went down to 80%, then 60%. 2025, it got really hurt. It was down to 40%. But now any asset placed in service, purchased and placed in service after January 19th, 2025, the bonus rate is now set at 100% bonus depreciation. And it was made permanent, meaning there is no more phase out. So it's not going to go down by 20% every single year, or in 5 years it's going to be cut in half. This is now made permanent. 100% bonus is here to stay unless a future Congress decides to pass a new law and change it. So what that means is any property that you go under contract and you buy it after January 19th, 2025, you do a cost segregation study on it, you identify those 5 and 15-year assets, you will be able to write the full value of those eligible assets in the first year. Again, whoa. Now, there are some nuances that we're still waiting for some guidelines from. We need some guidance from the IRS and from the regs to come out. There is some gray area. They did specifically state that if you were under contract to purchase a property, a binding contract before January 20th, 2025, this 100% bonus does not apply. So you're going to find some interesting scenarios where you were under contract for a property, say January 5th, you were under binding contract and you didn't close until February. Even though it's after the January 20th date, you will not get that 100% bonus. You will still be under the old tax regime of 40%. And there's going to be some interesting scenarios where somebody bought a property, didn't place it in service. Do they get the 40%? Do they get the 60%? Do they get the 100%? So this is where we're still looking for some guidelines. I have a pretty good idea of how it's going to shake out. But for now, anything that was purchased before January 19th or was under a binding contract before January 19th is going to be under the old regime. Anything after January 20th or later would get the 100% bonus depreciation. Great. So now the big question is, okay, Mr. Lasky, you did a cost segregation study on my property. You generated $1.1 million of depreciation expense. My property that I own is making, $200,000, $300,000 of income. I have an $800,000 loss now. What can I do with that loss? And I'm going to say that's an excellent question. Let's get on a phone call and discuss it with your CPA and go through all the details because it gets a little bit complex, but let's go through a little bit of the highlights. So there's something called passive versus active, and I'll try to explain this in very, very short terms, but the way I like to explain it is, passive income and expense is versus active income and expense. The way I like to describe it is you have two ways of generating money. One is you could trade your time for money, or you could trade your money for money. So time for money is what we're all familiar with. You have a W-2 job, you're working a 9 to 5, you're independent contractor, whatever it is, but you're trading your time, your experience, your expertise, your skills, you're trading your time for money. That is, you are actively producing income. So that is called active income or loss. If you're generating a loss, you're not running a very good business and you're losing money, then that would be an active loss. Passive income is when you are passively generating income, not by trading your time for money, but trading your money for money. You buy a piece of real estate, or you go to Amy and she buys the real estate for you and she's managing whatever it is. So there, you're not trading your time and experience and skills for money. There, you're trading your money for money, and that is considered passive. That would be a passive income, or if it generates a loss, in our case, you do a cost segregation study, generate $1 million of depreciation expense, and now you have a loss, that would be a passive loss. So what's the issue? The issue is passive and active, generally speaking, do not mingle. So if I have $1 million of W-2 income and I have $1 million of passive loss, I cannot, generally speaking, use that passive loss to offset my active income. Now, there are a couple of exceptions. So the big exception that we're going to talk about is REPS, real estate professional status. So if you qualify as a real estate professional, and this is something that you would have to discuss with your CPA, I'm happy to be part of that conversation. It's a little bit more complex, but I'm giving you the high level over here. There are essentially 3 tests. There's the 50% test, which means you have to spend 50% of your time in the real estate trades or businesses. Meaning, if you have a 9 to 5 job working as an accountant, so you're working 40 hours a week, you have to spend 41 hours additionally on top of those 40 hours as a real estate trader business. So now you're working 81-hour weeks. Does not sound like fun. Additionally, you have a 750-hour test. So let's say you only have a part-time job, you're working 10 hours a week. So now you only have to work 11 hours a week as a real estate in the real estate trader businesses. You still have a minimum of 750 hours that you have to spend per year in real estate trades or businesses. And then there's a material participation test. That one's a little bit more complex, not for today's discussion, but essentially you have to hit these 3 tests in order to qualify as a REP, so real estate professional. Now, what's the benefit of a real estate professional? So again, if you remember what we're discussing, are you trading your money for money or your time for money? So if you're spending 50% of your time and a minimum of 750 hours in real estate, so you could claim to the IRS, I am no longer passively involved in real estate. I am actively involved in real estate. I am trading my time, my skill, my expertise in real estate in order to generate money in real estate. So therefore, my real estate losses are no longer considered passive. They are now considered active. Therefore, I would be able to use my real estate losses, which are now deemed active, to offset even my W-2 income. There are certain limitations. There's the business loss limitation. There are some things to keep in touch. Again, outside the scope of today's discussion, happy to talk to you individually or discuss with your own personal CPA about those different things that you definitely need to discuss. But that's the general idea of REPS. Again, if you're a real estate professional, you do a cost segregation study on your real estate, you generate a huge loss, you would now be able to use that loss to offset your active income. Now, let's say you don't qualify as a REPS. You are not a real estate professional. What can I do with this real estate loss? So if you have other passive losses, right? This is not your only real estate. You have one piece of real estate that's generating $1 million loss, and you have another passive investment in real estate that's generating $1 million income. You would be able to use your passive losses to offset your passive income. That's no problem. You don't need to be a real estate professional in order to utilize that. There's another exclusion, doesn't come up too often, but if you're married, filing jointly, earning less than $100,000, you get up to $25,000 of passive loss that you could use to offset active income, such as W-2 income. There is a phase out of a rate of 1 to 2, meaning for every $2 you earn over $100,000, you lose $1 of that $25,000 exception. So at $150,000, $150,000 of income, adjusted gross income, that $25,000 goes away. There are other situations. There's a very famous one that's making its rounds on the LinkedIn's and YouTube's called the short-term rental loophole, as commonly referred to. The idea there is that if you're actively participating, you're materially participating in an Airbnb or similar type of property, you can then claim that this is not a passive investment, this is an active investment. It's very similar to the real estate professional status. It's a little bit different, again, outside the scope of today's discussion, but definitely happy to have that conversation with anybody individually or discuss with your CPA. We definitely deal with a lot of clients that use this short-term rental loophole where you are not necessarily a real estate professional. You don't qualify under the 50% test or the 750-hour test, but on this specific property, the Airbnb, you materially participate, and therefore you would be able to, in certain circumstances, utilize the loss from that Airbnb property to offset W-2 income. Again, we can talk about that separately. Okay, now let's say it's not a short-term rental loophole. You're not a real estate professional. You're earning more than $150,000. So the answer is that any excess loss that you're not able to use this year, it's not a use it or lose it. It just carry forwards. It gets carried forward into subsequent years until it's all used up, or eventually if you sell that property, then all that passive loss gets released and you'll be able to utilize it at that point. So it's not a use or lose it, it's a use it or carried forward into subsequent years. So cost segregation sounds amazing. It sounds like it's a win-win. It sounds like it's a no-brainer. So why would somebody not want to do a cost segregation study? So the first answer is, let's say you have no income, right? Your properties are not generating income, your W-2 is not generating any income, or you're not a real estate professional, so therefore you can't use it to offset your active income. But the main point is you have no income to offset. So if you have no income, you have no tax liability, then you don't really need any losses to offset your non-existing income. The whole play here is to offset that income, to lower your taxable income, to lower your taxes that you're gonna have to pay. If you're not paying taxes, there's no point in doing a cost segregation study. The next reason why you should not, if you ask me, I would tell you probably it's not worth doing a cost segregation study, is if you're planning on selling the property within the next year or two. The whole play here with cost segregation is a time value of money play, right? So if I give you the deduction today, I'm gonna give you $1 million write-off today. Eventually I'll have to pay back in 5, 6, 7, 8, 10 years. So you could look at it as an interest-free loan from Uncle Sam. However, if you're selling that property within the next year, at that point of sale, you're gonna have capital gains, you're gonna have depreciation recapture, and all that benefit that I just got you, you're gonna have to pay it back a year later. So then you have to do the cost benefit analysis of paying for my services, doing the cost segregation, getting all that deduction, and then paying it back a year later. There are certain circumstances where it does make sense. So we'll take it by case. Again, always happy to jump on a call and talk it out. But that would be a situation where I would say maybe it doesn't make sense to do a cost segregation study just because the time value of money is not really there if you're only holding it for 1 year. Another reason is some people like paying money in taxes. I don't understand those people. I don't get it. If you're one of those people, then I can't really help you. I could give you other places. My kids want to go away to sleepaway camp. It's pretty expensive. So if you like writing checks, I could definitely give you places to write them. But If you like paying taxes, you feel it's your patriotic duty to write taxes. My patriotic duty is to help people keep as much of their money as possible within the confines of the law. The last reason not to do a cost segregation study is, as we mentioned before, when you sell the property, there is going to be a tax due. There's capital gains, right? If you bought the property for $1 million, you're selling for $2 million, you're going to have taxes on that gain. Similarly, any depreciation expense that you've taken over the life of that property, assuming you sell it for a gain, you will have a tax at that point. So again, this goes into the time value of money. How long are you going to hold that property? If you're selling it right away, it might not make sense. If you're holding it for longer, then it might make sense. There are ways to mitigate this depreciation recapture at the point of sale. Obviously, 1031 exchange is one of my favorite and most powerful tools outside of cost segregation for real estate investors, where you could roll that taxes, the capital gains, depreciation recapture, and roll that into a new property and keep deferring those taxes. It's called the buy till you die strategy, and then your children inherit the property with a step up in basis, no taxes due. It's a great strategy. So cost segregation, 1031 exchange. There are other ways to mitigate it with a tax rate variance. You get the tax deduction today at the highest income tax rate, and you pay most of it back at a 25% tax rate. So there are still benefits even with this depreciation recapture. But these are just things that I want to make sure that everybody's aware. You know, you say cost segregation, it's a home run, it's always makes sense. There are certain circumstances where maybe for your personal tax planning strategy, it does not make sense. And this is where you want to get on the phone with your CPA, myself, anybody else. We're happy to walk you through it and, you know, kind of hash out all of these different scenarios to see if cost segregation is right for you. So as closing, I don't really have a closing statement, but basically cost segregation is a phenomenal tool for real estate investors, again, with other 1031 exchange, other things like that. But this is definitely one of the most powerful tools for somebody looking to really build their portfolio, save on taxes, and keep the train rolling. This is my passion. I love cost segregation. I think it's amazing. I'm happy to field all of your questions. If anybody has any questions on what we discussed today, one big beautiful bill in general, happy to discuss, cost segregation, real estate, you name it. And as I think we mentioned in the past, if anybody wants to reach out directly, here's my phone number. This is my email address. You could reach out directly. Happy to set up a 30-minute call, review any of your questions, any of your situations. If you have a specific property that you're looking at considering doing a cost segregation study, I'd be more than happy to take a look at it, do an estimate for you, let you know if it makes sense.
Right. That was outstanding. Very, very thorough. We've got several questions. But yeah, thank you. It's good. It's good. It's good. Before we jump into questions, thank you everyone for putting them in the Q&A section. I see we have some on LinkedIn as well. Do want to let you all know, because I do see many of you who are investors with us at Silvus Capital that invest passively. For those who are wondering, we do pass on depreciation benefits to our passive investors. So some people ask us sometimes, hey, is this benefit just if I own my own single family or a triplex or something like that? And the answer is obviously, you know, that could be appropriate for that segment, but also if you do invest with us in what's called our syndications, you are able to capture some of those depreciation benefits as well, which a lot of people really, really enjoy. So wanted to mention that. All right, our first question comes from Anna Wong. She is wondering, for cost seg, what if you own the property for over 10 to 20 years? What are your options? Yeah.
So the answer is it depends. It really depends. So I just did a cost segregation study on a property that was purchased in, I think it was 2007.
Ooh.
Okay, so a couple of years ago, let's say, we still ended up, I think it was about $800,000 of benefit in year one for them. Additional, meaning whatever depreciation, again, we got $800,000 of additional benefit. So the answer is it really depends. It depends on what is the basis in your property. If your basis was $500,000, there's probably not enough meat on that bone. Like if you came to me year one, year two, absolutely. You're coming to me year 10, 15, there's probably not enough benefit to warrant a study, to pay for our fees, to go through, it's not much of a headache, but whatever it is, to go through the exercise for a $500,000 basis that's already 15 years already eaten up, Probably not much. Also, it depends on the property type. So we didn't really discuss this in the slides, but different property types will yield different types of results. So just to give you two extreme examples, let's think about a warehouse. So I'm talking about an empty warehouse. It's just cement floors. There's no office space. It's just like a roof and four walls, nothing in there. We're going to get minimal benefit on a property like that. Now, there could be a lot of landscaping, there could be a parking lot, there could be some machinery and equipment inside, there could be loading docks. So these are all things that we're going to look at and try to get as much benefit. But if you're thinking about like an empty warehouse, there's not going to be that much that we're going to be able to break out in benefits. Now, if you think of a nursing home, you have beds, you have machinery, you have equipment, you have flooring, you have so much stuff and countertops and nurses station. There's just like a lot of stuff there where we could break out 20, 30, sometimes higher percent of the basis we could break out as bonus eligible assets. So to answer, I know it's not really answering, but to answer your question, the answer is it depends how much basis is there and what type of property we're looking at. And as always, I'm happy to run a free estimate, take a look at the property, show you what the benefit or no benefit, and we can definitely have that discussion. Does it make sense to move forward or not?
Fantastic. Thanks for being so generous with your time. Anna, thanks for the great question, friend. If you want further clarification or if you have any add-ons, let us know. All right, Mr. Todd Spooner, another great question. On what size of property does it make sense to do a cost seg, assuming some properties may not be worth it due to the property value?
So similar question, but a little bit different. So the answer is, generally speaking, $500,000. So I don't really go by the size of the property. It's more of the value of the property, how much benefit is there. $500,000. We do see sometimes lower value homes, single family homes, we still get enough benefit. Again, we'll always run an estimate for you. You give me a $300,000 property, I'll run an estimate for you, and then show you got $50,000 of benefit or $20,000 of benefit after taxes. Is it worth our fees? Always happy to have that conversation. But generally speaking, $500,000 on a purchase or major renovation is kind of like the minimum of what I would look at. Again, if it's case by case, if you really need that tax write-off, maybe it's worth it. But yeah, I would think of $500,000. And again, it also depends on the property type. If it's a $500,000 warehouse, probably not going to have so much money there. $500,000 single family home with a pool and a nice movie theater in the basement and a lot of furniture and things like that, yeah, absolutely, there could be $100,000 or more of benefit. So case by case.
Awesome. Todd, let us know if you have any follow-on questions. Thanks for the great question. We're going to go over to LinkedIn, where Kay asks, hey Kay, it's always so good to see you. When is the best time to do a cost seg, before or after rehab?
Oh, that's a very, very hard question to answer. Okay, so
you're welcome.
Let me preface that we don't here at Madison, we do not advise to have the tax tail wag the investment dog.
Yes.
Okay, so if you have a business plan of buying a property, I'll just talk single family home, but you have a single family home, you're buying it, you're going to renovate it, put it on Airbnb. So I don't want you to not renovate it in order to get that extra $20,000 or $30,000 of tax benefit if that's not part of your real estate business plan. That being said, so when you're dealing with a purchase and a renovation, it gets a little bit complicated. And let me explain it like this. What we want to make sure we're not doing is double counting assets. So for instance, you buy a single family home and we're going to identify you have $10,000 of carpet in that home. And then the next day you go and rip out that carpet and put in a brand new carpet. The IRS, rightly so, is going to argue that that original carpet had zero value because you proved it. It's sitting in that dumpster right behind me. So it's going to be very hard to argue to the IRS that that original carpet had any value if you're immediately ripping it out and replacing it. Now, in order to avoid this complication, generally speaking, if you have 2 tax years and preferably at least 6 months separating the purchase and the renovation, then we feel there's enough of a leg to stand upon to say that original carpet had value. It was in service for 6 months. We had it in service for 1 tax year. And then the next year we ripped it out, no problem. If you're going to be doing the renovations anyway, depending on how extensive, if you're going to be doing a gut rehab of that house or that building or whatever it is, there's probably not going to be so much value in doing an original cost segregation study on that original purchase because all of those assets are being ripped out. We could definitely look at doing a cost segregation study on that renovation, And again, we didn't discuss about this, but depending on the type of property, there could be qualified improvement property. There could be very significant benefit on doing a study on that renovation side. But if you're going to be doing a gut rehab right away after purchase, probably not going to be a good candidate for a cost seg study on their original purchase. I've had scenarios where a guy bought an apartment building, 100 units, and he renovated 50 of them. So I said, great, we'll do a cost seg study on the other 50 units that you didn't renovate, and we'll do a cost segregation study on the renovation portion of the first 50 that you did renovate. So we could definitely work with you and strategize what makes sense. We've had guys who kind of pushed off doing, again, against my advice, but pushed off doing a cost segregation study, pushed off doing a renovation study for that 6 months and 2 different tax years. So that way he could kind of double dip, do a cost segregation study on the original purchase, have it in service, and then 6 months, 7, 8 months later, start the renovation and kind of get that second benefit on the renovation side. So it's a little complex. These are things that I would really want to speak out with you, one-on-one, and kind of go through the scenario, go through exactly when you bought it, when you're planning on doing a renovation, what are you renovating, how extensive is it, because all those answers are going to kind of cater to what type of study we would propose.
Okay. Thanks, Ari. Thank you. And thanks, Kay, for the question. Kay always asks
great question.
Really great questions. Yeah. She's a smart one. All my investors are smart. I'm so fortunate.
There's a reason why they're on this webinar.
Yeah. Mr. Eduardo, hey friend. He asked, I have multiple rental properties in 3 different states. Can I apply the cost seg and bonus depreciation? Do I need to file 3 separate state taxes? How about the federal tax level?
So assuming they're all single member LLCs, that's you're wholly owned by you, they would all flow onto your personal tax return. So if you have a loss from one, a gain from the other, you would offset one from the other, all flowing through on your personal tax return. Now, if you're a real estate professional, that's kind of what we discussed before about the passive loss, active loss. So that's something definitely have a discussion with your accountant, how that would flow through to your other sources of income. So that's really case by case. Regarding the states, yes, you will have to file separate state tax returns depending on where the property is owned. And again, that's something to discuss with your personal CPA regarding the state taxes and whether or not they recognize the bonus depreciation. They do recognize cost segregation. So I just want to make sure you understand that the cost segregation study will still benefit you on your state tax return. They just might not allow the bonus. And there are certain circumstances, I know New York, as an example, I believe Pennsylvania also, there are times when you want to maybe opt out of the bonus depreciation because you might get hurt on your state tax return. So this is definitely something you want to not just go into blindly and say, yeah, let's go bonus it up, take that 100%, go all in. Like there is a little bit of, yeah, exactly, rah, rah, rah. There is a little bit of strategy that has to be thought through with your tax professional to make sure we're maximizing both on your federal and states.
Perfect. Great question, Eduardo. And as we mentioned quite a bit, or I tell my investors, make sure you're consulting with a CPA that specializes in real estate. It makes a big difference. It's kind of like seeing an eye doctor if you're pregnant. It doesn't mean that your eye doctor won't be able to help you deliver your baby, but there may be someone that's a bit more knowledgeable and specialized. So yeah. Maybe not relatable. Maybe many people here haven't been pregnant, but you get the idea. Specialization matters. You may get a more in-depth knowledge to be able to deal with your personal situation.
Yeah. And we work hand in hand with many CPAs throughout the country, specializing in real estate. And, we're happy to work together with your CPAs as well.
Love it. I love that collaboration. Jackie, you've got a great one. I've got an answer, and then I'll let Ari answer too, because we'll have two.
Sit down, take a break. Okay, good.
Yeah. So if I have $1 million in capital gains on a property I bought in 2020, does investing in syndicated multifamily property in 2025 that does a cost seg process mitigate the capital gains liability from the sale of my own property? So let me give a quick answer just on the practicalities of this, and then Ari can say his specialty. We have a lot of folks that 1031 exchange into our syndications. A lot of folks don't know that that's possible. We do have a minimum amount. It's usually around $500 to $1 million to 1031 exchange into these syndications. Not saying you should, not financial advice, but just letting you know that's possible. And we also have other people, I actually see several names in this Zoom room that have done exactly this with the depreciation. They didn't want to 1031 exchange, but they did what's colloquially known as a lazy 1031 exchange, which is to take the depreciation and use that to talk. And I'll pass it on to Ari so he can
A
talk about.
lazy so I call it a backdoor 1031 exchange, but
Okay.
lazy 1031 exchange, I like that too. That's good. I've never heard that one. A lazy 1031 exchange. So yeah, exactly the point. So there are two ways to mitigate that 1031 exchange, and I actually had a conversation with a client yesterday or 2 days ago about this, where they sold the property, they messed up, they should have done a 1031 exchange, but too late. Once you touch that money, just for anybody who's not familiar with 1031 exchange, the idea is that you sell a property and use that funds to go and roll forward into a new property. Now, you can't touch that money. You have to hire a 1031 exchange intermediary. Full disclosure, Madison does have a 1031 exchange department, so happy to help you out there as well. But you have to give that money to the 1031 exchange intermediary. They have to go and buy the property for you, and then all that capital gains, depreciation, recapture, that all gets forward into the new property. So you won't have to pay the taxes. It all gets deferred. Now, I had a client who messed up. They touched the money. Once he touched the money, 1031 exchange is off the table, and now he has a huge tax bill. So I offered this lazy 1031 exchange, or what I call the backdoor 1031 exchange, is use that money, buy a new property, do a cost segregation study on that property. You'll generate a humongous loss and use that loss to offset the gain from that sold property. So again, lazy backdoor 1031 exchange. Yes, the answer is yes. This is another strategy that we do utilize.
The one thing we love, Jackie, just to add just a tiny bit more color on this, where Madison actually helps us tremendously, is when we're buying a property, as you can imagine, we can't do the cost segregation study until we take possession of the property. But we do let our investors know as they're evaluating the syndication opportunity an estimate of what the bonus depreciation might be. It is not exact, but Madison Specs actually does a nice job of giving us kind of a ballpark estimate, and we are very transparent that this isn't the exact number, just so you can evaluate and work with your specialized CPA and understanding what sort of tax benefits that you may get, so you can make the decision that's best for you. Hopefully that's helpful, Jackie. Let us know. All right, last chance, y'all. We have an expert about this exciting new 100% bonus depreciation that's back. We've all been waiting for it. Any other questions from Ari?
Yeah, and again, if you don't want to be on the chat and have your question typed in, or if you don't
Yeah.
think of it right now, again, Jackie, Amy, sorry, you could share my contact information. You could
Yes.
always reach out directly, call me, email me, set up a call. We're happy to walk through your specific scenario.
So generous, so generous. And y'all, as we close up here, I've put Ari's information in the chat on LinkedIn and on Zoom. You're going to be getting a recording of this, and we'll give you Ari's contact information too in that email. So we'll make sure, and of course, you know how to get a hold of me just in case you can't locate his contact info. As we wrap this up, I do want you all to know we do have an open investment opportunity, hands-off real estate investment opportunity. So if you're looking to get in the game, reach out to us at info@silviscapital.com, and we can give you more information about our open investment opportunity. Ari, thank you so much.
My pleasure.
You are so generous with your time and your expertise. Everyone, thank you for these great questions. I encourage you. We have a very strong working relationship with Madison Specs, and so we're just delighted to introduce them to you, and you see the quality of information and support they're willing to give us, just top notch. So Ari, thank you so much again.
My pleasure. Absolutely. Looking forward to next year's.
Oh yeah. Thank you.